Good morning. Today is Friday, December 8th. I'm Joe Terril, president of Terril and Company, private wealth managers headquartered in St. Louis, Missouri. This is an update on our thoughts about investments, the economy, inflation, and all of the things that ultimately make the valuation of investments. Recently, we have seen a dispute between people who believe the economy is weakening and therefore the Federal Reserve Bank is getting ready to step in and cut interest rates, and we will see interest rates go back to 2% because inflation's going back to 2%, and therefore you had better buy long-term bonds, etc. We completely disagree. Here in a nutshell is our outlook, at least for the next 3 months. The economy stays strong in the United States and around the world. Interest rates stay up. Don't see any central bankers anywhere around the world willing to cut interest rates, particularly in the United States. The battle against inflation is not won. Inflation is coming down, but in the last 2 years compounded, we've had 15% inflation. I don't believe the Federal Reserve is anxious to cut interest rates back to 2% and take the chance that they will reinvigorate inflation, if you will, by printing too much money. So we believe the Federal Reserve when they say interest rates are going to stay higher for longer, and we're structuring portfolios accordingly. The unemployment figures this morning that came out bear us out in our thinking. And this isn't thinking that we recently developed. We've been in this camp for a solid year now and have been correct and have portfolios structured correctly. And the figures that were out this morning show employment is very strong, wage gains are strong, and there's no sign anywhere of a weakness in the economy. Therefore, we don't see any need for the Fed to start worrying about we'd better cut interest rates and stimulate the economy. With that said, bond prices and fixed income prices have been a disastrous place to be in the last couple of years, particularly if you've had any type of duration. If you stayed in very short-term bonds or floating rate issues, as we have at Terril and Company, you've avoided any problems. For those that bought longer term bonds, you've had losses of 10 to 15% even after you collected your interest. So we've had a rally in the bond market on expectation rates are coming down, but we think that's a short-lived rally, and somewhere by the end of the year, early next year, interest rates will turn around and go back up to levels that we saw in the middle of the summer. As it relates to stock prices, you still are witnessing a bifurcation between average companies and what I call the glamour stocks. The media calls them the Magnificent Seven. They are high capitalization companies that, because of their capitalization, they now dominate what's going on with the averages. So I like to point out to people, the S&P 500 ballpark is up about 18% this year. But if you exclude 7 stocks and look at what the other 493 have done, they're up about 5% this year. Similar thing was true last year. Last year when the NASDAQ fell 30%, the majority of that fall came from the big high-tech, high capitalization stocks. So the only reason we bring this up is there's this barbell approach. We're not interested in the very expensive high multiple glamour stocks. We are interested in the very low multiple high dividend paying companies. We purchased quite a few of these stocks, a Verizon and AT&T, a Citigroup, the regional bank index, among others, some of the gold stocks in October when it was tax loss selling season and a lot of mutual funds and hedge funds were dumping these things. So we believe that end of the market is reasonably priced, will continue to hold up through the end of the year and into next year. And we see good investment ideas in that area with a Walt Disney, a Hershey's. There are a number of companies that we like there that will continue to add to portfolios on pullbacks. So to summarize, strong economy around the world, no evidence any central banker is anxious to cut interest rates, and inflation we got to monitor. We don't believe that the battle is won against inflation. The Keynesian economists that are in control at some of the central banks around the world once again have been proven wrong. Our own our own Jerome Powell, head of the Federal Reserve Bank, a few years ago said we should unlearn Milton Friedman, who won the Nobel Prize in economics for monetarist theory, that we should unlearn that. Well, as he said we should unlearn that, and he told us inflation was just transitory, that's all been proven wrong once again. So our real outlook, if people ask, what are you watching? We're watching to see at these central banks around the world what they are going to do. Are they going to follow their Keynesian beliefs, even though they've been proven wrong time and time again? Or are they going to maybe question themselves and develop a different policy? We don't know because they don't even know. But that's what we're watching. The money supply in the United States has been timid, but we won't bore you in one of these videos as to why the money supply is being counted in a different method. So for now, we're staying very short term and think others should do the same with any type of fixed income. Look at good dividend paying stocks that are selling at very historical, reasonable multiples. We still think gold offers a lot of opportunity, and we will add 2 positions if prices pull back. So that's our outlook. We appreciate you tuning in. Very happy holiday season to everyone. Brian Curtis, our producer of these videos. Brian, very happy holidays to you and your family. And we'll be back maybe once more before the end of the year with updates. Thank you.